Roku should be one of the winners in the streaming industry. This is a company that is actually distributing a lot of other streaming companies, has a dominant position in the operating system for TVs, but the company can't seem to make money. And I think there are a number of just general flaws with the company's business model that investors need to think about. Some of the things are trending in the right direction. Operating costs are starting to come down. Revenue is improving a little bit. And I would think that long-term, Roku should be really well positioned. But we haven't gotten to the point where we can really say that Roku has a sustainable business model that's going to be able to grow long-term profitably. And I think that last part, the profitable part, is really the question that I have about Roku. But I want to go through results and kind of go through what I'm thinking about this company, why it's intriguing to me, and why I haven't yet bought shares. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's first look at the stock chart because I think the reaction to earnings was really interesting. This is a look at Roku's stock over the past 5 days, and you can see that this is actually when earnings were announced. It was right here. That's when shares dropped pretty sharply. But if we pull back a little bit further, shares have been kind of all over the place over the past year. They've basically doubled, and then they've fallen 50% again. And over the past 5 years, shares are actually down 10%. So this is a little bit strange for a company that I think is probably in a better position today than it was 5 years ago. But going through the numbers, I think tells the story of why investors are at least concerned about the company. This is a look at the earnings results. And you can see here that everything is just generally trending in the right direction. A number of streaming households up 14% from a year ago. Not a big jump quarter over quarter. And then streaming hours up 23%. Again, relatively small jump. Platform revenue was actually down sequentially, but you would expect that at least a little bit because the holiday quarter is going to be a pretty solid quarter for Roku. Put up 19% on both a platform and devices side of the business. Devices, one of those things where Roku needs to get more devices in people's hands, but is generally going to, at best, break even on those devices. So that's exactly what you see here. They have lost money each of the last 4 quarters on a gross profit perspective on their devices. But where they're going to make money is on the platform, and that is where you see revenue up 18%. So revenue not quite keeping up with the growth in, that's where you see gross profit up 18%. So gross profit not quite keeping up with revenue growth or streaming hours growth. So just a little thing you should think about there. I think we can also now note that platform gross profit margin is down year over year. This is something that you don't necessarily want to see pricing pressure on this because that indicates that suppliers are putting pricing pressure on Roku. And then you have R&D. This is all these operating expenses that are down. R&D, sales and marketing, general and administrative. This is the kind of cost correction that Roku has really need to make. But you, at the end of the day, still get a company that lost $72 million in the quarter. That was a 66% improvement from a year ago, but you're still losing money despite the fact that you're generating now positive free cash flow. So like I said, it's a bit of a mixed bag from a results standpoint. You do have revenue going up. You have operating costs coming down. Those are the trends that you absolutely want to see. But are they going to be sustainable long term? Let's look at the statement of cash flows because like I showed earlier, there was positive free cash flow for the quarter, but let's dig into exactly what those numbers look like because you start with a negative $51 million in losses for the quarter. And then these are all the things that you add back or subtract depending on what the numbers are, but you add back something like $94.6 million in stock-based compensation. Suddenly, look, you're profitable if you don't include an expense like stock-based compensation. Amortization of content assets, that's something that's going to be ongoing. There was a big change in accounts receivable. So that's great for this quarter, but probably not something that we can count on each quarter. And then you have an offset of things like content assets and liabilities and accrued liabilities for the business. So overall, operations did generate $46.7 million in revenue. That is moving in the right direction. So if we go back up here to the $426.8 million worth of free cash flow on a trailing 12-month basis, that's not quite the same rate that we had in the first quarter, but still has been positive, driven primarily by higher operating cash flow in the second and third quarter of 2023. So we will lap those numbers eventually, and that's where free cash flow might not look quite as good on a trailing 12-month basis later on this year. Now, management did talk about a lot of the improvements that they're trying to make, basically saying that they're the front door to people's streaming experience. If you're using Roku on your TV, it's Roku who really has control of the first things that you see. So this is what they were showing with NFL Red Zone. They go through examples of being able to recommend different shows. So this is areas where other companies can advertise on their platforms. So these are all the revenue generators that Roku could potentially grow from because they are that front door to the streaming experience for millions of people. They also have Roku Pay, and this is again where they're going to take a cut of any sort of streaming subscription that you are signing up for on Roku. So that again should be a very valuable business. The question there is going to be how much pricing power do they have over some of their competitors, and that's fundamentally where I think there's a challenge for Roku, because there might be limits to how profitable the company can ultimately be. And that's why I actually want to see net income positive and generating consistent free cash flow before getting too excited about shares. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The challenge for Roku is how much power do they really have in the streaming market? Yes, they have the ability to have advertisements if you're on their platform, but are people buying TVs specifically because they're a Roku TV? I know I'm an Apple TV user. I would just rather not have Roku at all on the TVs that I have that have Roku on them. So for me, in that sense, it's not a selling point. And I think there are probably a number of people who are the same way. But there are also other people who are using Roku as their front door to streaming. And this can ultimately be a really positive experience. But Roku is only on about 40% of TVs. So let's say half of those people are using Roku as their main TV operating system. Well, that's only a 20% market share. That's not really the kind of market share that you want to see in a streaming business, which should follow something like the smiling curve, where there are dominant players generating a vast majority of profits. Roku could play a role of being something like a cable bundle for streaming services if they're able to bundle together things like Netflix and Disney Plus, Hulu, Paramount, all of these services together. But right now, most of those services are trying to go with their own. Netflix in particular wants to have that direct relationship with customers. So it's not going to allow some of these other third parties to be an intermediary between them. They don't want to have that. Disney Plus in particular has taken a little bit of a different approach. They want to have that direct interaction, but they do have some licensing deals where they're allowing customers to sign up through things like cable networks and cable bundles. So they want to be bundled with other valuable services. And then you get the smaller players like Paramount Plus, like Peacock, who are just desperate for any customer that they can get. But that's not ultimately the kind of value that you're going to generate for a streaming service. So those businesses are losing hundreds of millions of dollars. And if you're building your business on these money-losing streaming services that can't keep up from a content perspective because they don't have the financial wherewithal to keep buying content the way that Netflix and Disney do, then you're kind of in a weak position strategically. And that's fundamentally why I haven't jumped into Roku yet, is I don't necessarily see them taking a cut from Netflix and Disney Plus long term. And if they don't have those services, you're going to run into the same thing. You're going to run into the same thing that cable companies ran into when they dropped a channel like ESPN. Customers got really mad when you couldn't access ESPN through your cable bundle, and it was the cable company who took the brunt of that. Well, if Roku takes Netflix and Disney Plus off because they say, hey, we want to take a certain cut of every customer who comes through Roku, or we want to be able to resell your product, then customers are going to be mad that those services that they're signing up for, now hundreds of millions of subscribers, aren't accessible on Roku. And this is fundamentally the problem, is they have very little pricing power, and that's exactly what we've seen. So until we see some sort of sustained profitability, Roku is just a stock that I'm going to watch from the sideline. I want to be a little bit more bullish on the company. I think we're starting to see some value from a balance sheet perspective. The stock's not terribly expensive. And if free cash flow continues to be positive, that would be great news. But it doesn't look like they have the kind of pricing power and operating leverage that I want to see in a business like this long term. Most of that power is going to those big streaming companies. In particular right now, Netflix and Disney are the two that are growing the fastest and have simply the most scale in the market. But what do you think about Roku's results and the position that we're in streaming right now? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you next time.